Picture this headline flashing across every financial news channel at once. Canada comes out on top as America's trade war backfires. At home, traders freeze mid-sentence. Currency screens flicker red and green in the same breath. Analysts who spent months insisting the smaller economy could never outlast the larger one suddenly have to explain themselves live on air. Somewhere in Warren, Michigan, a 51-year-old machine shop owner named Mike Delaney is standing in his garage bay, staring at an invoice that just went up by almost a third overnight. Mike has spent 26 years supplying precision brackets and stamped metal components to the auto industry, the kind of unglamorous parts nobody thinks about until their car doesn't start. His shop survives on tight margins and tighter timing, and for decades that timing depended on a smooth, almost invisible flow of steel, aluminum, and finished components, crossing the bridge from Ontario into Michigan like clockwork. Then the trade war arrives, not as a single event, but as a slow, grinding escalation that started back in early 2025, when Washington imposed sweeping tariffs on nearly everything coming from north of the border, and Ottawa answered with tariffs of its own on tens of billions of dollars worth of American goods. What follows over the next year and a half is not a clean knockout punch from either side. It is a long, messy, exhausting war of attrition, and by the summer of 2026, it escalates again when Washington announces a fresh 50% tariff on a wide basket of Canadian goods, everything from dairy and hockey equipment to plywood and wine, set to take effect that August. And this time, there is no exemption for products that would normally qualify under the North American Trade Agreement. For a guy like Mike, none of this is abstract. His shop sits in the Tier 3 layer of the auto supply chain, the small, easy-to-overlook businesses that feed parts up to bigger suppliers who feed parts up to the automakers themselves. And industry researchers have been warning for months that this is exactly where the pain lands hardest, because these small shops cannot afford the tooling costs required to suddenly relocate production onto American soil. And lead times for domestically built tooling have reportedly doubled. Automakers get offset programs worth a few percentage points of vehicle value to soften the blow of building in the United States. Mike gets nothing but a bigger bill. He started absorbing costs just to keep his contracts, eating into margins that were already razor thin, because losing the business entirely would be worse than losing the profit on it. Meanwhile, 300 miles north, something unexpected is happening. Instead of collapsing under the weight of American tariffs, the way many assumed it would, Canada begins leaning hard into a strategy it had only talked about for decades, actually diversifying away from near total dependence on the United States. For most of modern Canadian economic history, a business plan built around exporting exclusively to the U.S. made perfect sense. It was next door, it spoke the same business language, and it was the largest consumer market on the planet. But tariffs changed the math. Canadian exporters start looking east across the Atlantic and west across the Pacific with fresh urgency. Surveys of over 1,000 Canadian exporters conducted heading into 2026 find that roughly 2/3 plan to enter new markets within 2 years, with close to 30% specifically targeting Europe and nearly 1 in 5 eyeing Asia-Pacific, leaning on existing trade agreements like the deal with the European Union and the Trans-Pacific Trade Pact that already give Canadian companies preferential access and lower tariffs in those regions. A trade confidence index tracked by Canada's Export Credit Agency actually climbed several points as this shift accelerates, a small but telling signal that businesses are regaining footing even as the fight with Washington drags on. Ottawa sets an ambitious target, doubling non-U.S. trade to roughly $600 billion. And while officials admit that number is still a long way off, the direction of travel is unmistakable. Nowhere is this diversification more visible than in energy. For generations, Canadian oil flowed almost exclusively south into the United States because there was no other way to move it efficiently. Then the expanded Trans Mountain pipeline comes fully online, tripling capacity out to the British Columbia coast, and for the first time in Canadian history, oil tankers start loading Alberta, crude-bound, not for Texas refineries, but for ports in China, South Korea, and beyond. By mid-2026, well over half of the ocean-going crude exports from that expanded pipeline are heading to Asia instead of the United States. And industry analysts note Canadian oil now trades against a global benchmark that often fetches a better price than the discounted rate producers were locked into selling exclusively to American buyers. Layered on top of that, Canada officially becomes a global liquefied natural gas exporter for the first time, with a massive new terminal on the West Coast shipping its very first cargo in the summer of 2025, and every single shipment since then heading to Asia, led by South Korea. A second wave of LNG projects is already under construction to expand that capacity further. None of this means Canada has replaced the United States as a trading partner, not even close. The American market still absorbs the overwhelming majority of Canadian exports, but the psychological and strategic shift is real, and it gives Ottawa leverage it simply did not have a few years earlier. Back in Michigan, Mike doesn't care about pipelines in British Columbia. He cares about his order book, and his order book is shrinking. Consumers on both sides of the border start feeling the squeeze in ways that are impossible to ignore. Economists at the Federal Reserve run the numbers and find that tariffs implemented through late 2025 had already pushed core goods prices up by roughly 3% by early 2026, and that pass-through effect continues building for months after tariffs take effect, rather than hitting all at once. Forecasters at multiple major banks and research shops project headline inflation climbing further through 2026 as companies that initially absorbed tariff costs to protect market share finally run out of room and start passing those costs directly onto shoppers. Apparel prices jump, grocery bills already stretched thin, post some of the sharpest increases in years. Durable goods, the category that includes vehicles, appliances, and machinery, are expected to see a cumulative price increase approaching 5% over a couple of years, a smaller shock than the pandemic era. Price spikes, but a real and steady drag on household budgets nonetheless. One estimate from Wall Street puts the total inflationary impact of the tariff regime at roughly 1 full percentage point added to inflation over the course of a year. For families already dealing with high interest rates and a cooling job market, that is not a rounding error. That is groceries, gas, and car payments getting noticeably more expensive at the same time. Financial markets, meanwhile, cannot make up their mind. The Canadian dollar becomes a genuine roller coaster. At various points across 2025 and 2026, it slides to its weakest levels in years as investors pile into U.S. assets and interest rate gaps between the two countries widen. At other points, it claws back ground as the U.S. dollar itself weakens under its own uncertainty, and currency strategists openly admit they are trading headlines as much as fundamentals, with one analyst bluntly noting that trade war news is beating economic data as the dominant force moving the currency day to day. Equity markets swing on every tariff announcement and every hint of negotiation. Corporate earnings calls fill up with executives trying to quantify tariff exposure for nervous shareholders, and the kind of long-term certainty that businesses need to plan factory expansions or hiring simply evaporates. Back at Mike's shop, a shipment of aluminum stock that used to cost him a predictable, boring amount now fluctuates enough that he starts adding buffer language into his customer quotes just to protect himself. Two of his regular clients quietly start sourcing a small percentage of their orders from suppliers in the southern United States, not because the work is better, but because the paperwork is simpler and the tariff exposure is lower, and Mike watches a piece of his business drift away not because he did anything wrong, but because geography suddenly became a liability. Meanwhile, in Canada, the picture is more complicated than either side's headlines suggest. Manufacturing takes a real hit, with real GDP in manufacturing sectors dropping sharply year over year, steep declines concentrated exactly where you'd expect. Motor vehicles and parts, wood products, primary steel, and aluminum processing, all bleeding jobs, tens of thousands of manufacturing positions lost in a single year, concentrated heavily in Ontario, the province most exposed to cross-border auto trade. And yet, against a lot of early predictions, the overall Canadian economy does not tip into a full recession. Growth slows to a crawl, unemployment ticks up meaningfully, but per-person economic output stabilizes rather than collapsing. Exports of goods actually climb back above pre-tariff levels by the spring of 2026 as diversification efforts start showing real numbers, and forecasters who spent 2025 bracing for a technical recession spend 2026 quietly revising their outlooks upward instead. Part of the reason is structural. Close to 90% of Canadian exports to the U.S. still qualify for exemptions under the existing North American Trade Agreement, which cushions the blow far more than a blanket tariff regime would. Part of the reason is deliberate policy. The Canadian government rolls out billions of dollars in direct support for tariff-hit industries, steel and aluminum support programs, contingency FODs for the hardest-hit provinces, tax relief timed to boost consumer spending exactly when confidence needs it most. And part of the reason is simply Canadian consumers and businesses adjusting, buying more from each other, traveling domestically instead of crossing the border, and provincial governments pulling American alcohol off liquor store shelves and canceling contracts with U.S. companies in symbolic but economically real acts of retaliation. Then, right in the middle of all this, the foundational trade agreement holding North America together hits its own moment of truth. On July 1st, 2026, exactly 6 years after it took effect, the United States, Canada, and Mexico sit down for the agreement's first mandatory joint review, and Washington declines to renew it in its current form. The deal does not collapse. It technically remains in force for another decade under its own terms, but the moment where all three countries could have simply locked in 16 more years of stability quietly slips away, replaced instead by a requirement for annual reviews, and an open-ended negotiation process with no clear finish line. Business groups on all sides, including powerful agricultural lobbies in the U.S. itself, publicly warn that prolonged uncertainty over the deal's future is itself a tax on investment, because companies cannot commit capital to factories and supply chains they aren't sure will still make economic sense in 18 months. Back in Michigan, Mike hears about the trade agreement review on the evening news and barely reacts anymore. He has learned over the past year and a half that headlines about breakthroughs and headlines about collapse both eventually turn into the same thing for him, which is more waiting. Economic historians watching all of this unfold keep reaching for the same nearly 100-year-old comparison, the Smoot-Hawley Tariff Act of 1930, when the United States sharply raised tariffs on thousands of imported goods, hoping to protect American farmers and industry, only to watch trading partners retaliate with tariffs of their own. Global trade volumes collapse by roughly 2/3 over the following years. The downturn that had already begun turned into something far deeper and longer lasting. Most economists today agree that particular tariff act didn't single-handedly cause the Great Depression, but they also broadly agree it made an already fragile situation meaningfully worse and prolonged the pain for years after it might otherwise have eased. The lesson that gets repeated in economics classrooms and financial commentary alike is deceptively simple. No one actually wins a trade war. Tariffs might look like a tool that punishes the other side, but in a deeply interconnected economy, the costs almost always land on both sides of the border, just in different places and at different times, and often on people, like Mike, who never had a seat at the negotiating table where any of these decisions got made. As 2026 wears on, both governments start feeling real domestic pressure to find an off-ramp. In the U.S. getting, rising grocery and goods prices become a political liability heading into a contentious midterm cycle, and reports emerge of Washington quietly exempting more food and agricultural products from tariffs, specifically to ease affordability complaints from voters, with one analysis suggesting exempted categories already cover more than 1/3 of prior U.S. import value from Canada, a signal, however small, that the appetite for an ever-expanding tariff war might be softening. In Canada, business investment remains the economy's clear weak spot. Companies still hesitant to commit to major expansion while trade rules stay unsettled. And officials in Ottawa keep signaling openness to a renewed agreement even as they simultaneously keep pushing the diversification strategy forward, treating it less as leverage against Washington and more as basic insurance against ever being this dependent on a single customer again. Negotiators shuttle back and forth between capitals. Steel, aluminum, and lumber tariffs remain the toughest sticking points, industries where both countries have entrenched domestic producers unwilling to accept a deal that undercuts them. Slowly, painfully, targeted carve-outs start appearing. Tariff rates on certain agricultural equipment and industrial machinery get quietly reduced. Remission programs protecting steel used specifically in automotive and aerospace manufacturing get extended rather than allowed to expire. Small signs that, even amid all the public toughness, both sides understand the current path is unsustainable for their own industries. Back in his shop, Mike starts noticing something around the middle of 2026. An order for stamped aluminum brackets comes in at close to the old price. Not fully back to where it was, but close enough that he stops adding the buffer language to his quotes. It is not a dramatic turnaround. There is no press conference, no headline announcing that the trade war is over. It is just a slow, quiet stabilization, the kind that never makes the evening news, but shows up eventually in a small manufacturer's bank account. He rehires one of the 2 machinists he had let go the year before. He does not get back the 2 clients who drifted south. That business is probably gone for good. But new inquiries start trickling in from companies looking to diversify their own supplier base after watching what happened to companies that lean too heavily on a single source. Standing in his garage bay again, watching a fresh shipment of aluminum stock get unloaded at something close to a normal price, Mike thinks about how strange the last year and a half has been, watching global trade policy decided in Washington and Ottawa show up directly in his invoice totals, in his hiring decisions, and whether he sleeps well at night. He never had a side in this fight, really. He just had a shop, and employees and customers who needed parts on time. To understand how deep this particular trade war actually cut, it helps to rewind and look at the mechanics underneath the headlines, because tariffs on steel, aluminum, and copper did not stay simple for long. Washington kept adjusting the rules almost every few months throughout 2026, temporarily reducing rates on certain agricultural equipment and residential HVAC components, then turning around and tightening the threshold for what counted as foreign-made versus American-made content in derivative products, shrinking it from 95% down to 85%. A technical-sounding change that quietly pulled far more manufactured goods into the tariff net than most business owners initially realized. Customs officials gained new authority to penalize companies for misrepresenting where their materials originated, which meant Mike's accountant spent an entire afternoon in early 2026 just reviewing paperwork to make sure a batch of aluminum stock could still prove its Canadian origin cleanly enough to avoid a compliance headache. On the other side of the border, Canada's own response evolved in layers too. Provincial governments moved first and fastest, doubling toll rates for American commercial trucks crossing certain routes, pulling U.S. alcohol brands off liquor store shelves in province after province, and canceling government contracts with American technology companies in moves that were as symbolic as they were financially real. A grassroots boycott of American goods and travel took hold across the country almost organically, Canadians canceling vacations to Florida and Arizona, choosing domestic or European brands over American ones at the grocery store, driven as much by frustration over repeated comments from the American side about Canada becoming the 51st state as by the tariffs themselves. Ottawa backed the sentiment with over $1 billion in direct industry support, funding aimed specifically at steel and aluminum manufacturers trying to survive the squeeze, plus additional relief spread across every other tariff-hit sector of the economy. A financial cushion most small American suppliers like Mike simply did not have access to, since assistance on his side of the border flowed mainly to the large automakers rather than down to the Tier 3 and Tier 4 shops actually absorbing the sharpest cost increases. Agriculture became its own quiet battlefield too, with Canadian canola and other farm exports caught in overlapping disputes, not just with the United States, but with China as well, a separate trade conflict that had been simmering since late 2024 over Chinese subsidies and Canadian tariffs on Chinese electric vehicles, one that only partially resolved in early 2026 when Canada agreed to ease certain electric vehicle tariffs in exchange for China lifting duties on Canadian canola oil, a reminder that Canada wasn't just fighting one trade war during this period. It was managing pressure from multiple directions at once and using the diversification playbook against all of them simultaneously. Back on the American side, the agricultural lobby became one of the loudest voices pushing for stability, warning lawmakers that prolonged uncertainty over the trade agreement's future was already discouraging farmers from making planting and equipment decisions built around long-term Canadian and Mexican market access, and warning that further escalation risked handing that market share permanently to competitors in South America and elsewhere, who could offer buyers more predictable terms. Economists tracking the automotive sector specifically kept circling back to one uncomfortable data point. The parts manufacturing jobs in the United States had already fallen by roughly a third since the year 2000, a decline that predated any of this particular trade war and reflected decades of automation and offshoring, which made the political argument that tariffs alone could quickly rebuild that lost manufacturing base a much harder sell to economists than it was to politicians. Some analysts argued the strategy could still pay off over a longer horizon of 5 or 10 years if enough investment genuinely relocated into new American steel and aluminum capacity, essentially treating the short-term pain being felt by shops like Mike's as the unavoidable cost of a generational bet on reshoring heavy industry, while other analysts countered that squeezing the smallest, most fragile suppliers in the supply chain risked breaking exactly the domestic manufacturing capacity the policy claimed to be protecting, since a Tier 3 shop that goes out of business during the transition does not simply reappear once tariffs ease. That tension between a policy designed to rebuild American industry over the long run and the very real short-term damage it inflicted on the small businesses sitting closest to the border became the defining and most unresolved storyline of the entire period. Currency markets absorbed all of this noise in real time, and traders openly admitted they were reacting more to political headlines out of Washington and Ottawa than to traditional economic indicators like employment reports or interest rate decisions, a dynamic that made the Canadian dollar unusually volatile even by the standards of a currency long accustomed to swinging with oil prices. At one particularly rough stretch, the loonie sank to its weakest level in more than a year as investors piled into American assets, chasing a wider interest rate gap between the two countries, only to claw much of that ground back a few months later as a broader wave of doubt about the U.S. Dollar itself, tied partly to unrelated geopolitical tension overseas, pulled capital back toward Canadian assets almost by accident. Surveys of ordinary Canadians captured the psychological toll running alongside the economic one, with a clear majority expecting their cost of living to keep climbing and a similar majority bracing for the broader economy to get worse before it got better, even as the hard GDP numbers kept coming in better than that mood would suggest, a gap between sentiment and statistics that shows up again and again in periods of prolonged economic uncertainty, because people feel the price of groceries and gas long before they read a report about quarterly growth. For American consumers, the tariff story played out in a strikingly similar way. Price increases arrived unevenly, and with a lag, apparel and durable goods absorbing some of the sharpest jumps first, while other categories moved more slowly. And by the time headline inflation numbers caught up with what shoppers were already noticing at the checkout counter, the political conversation had shifted from whether tariffs were working to how long ordinary households would have to keep absorbing the cost while the two governments finished arguing. If you zoom all the way out from Mike's garage bay to the macro level, the honest answer to who actually won this trade war is unsatisfying, because it depends entirely on which month you're looking at and which industry you're measuring. Canada's diversification strategy genuinely worked better and faster than most analysts predicted. Oil and gas exports to Asia are real, growing, and not going away. Even if trade tensions eventually ease completely, the country avoided the outright recession that many forecasters had penciled in, and its overall economic resilience through 2025 and 2026 surprised even domestic economists who had been bracing for much worse. But calling that a clean victory ignores tens of thousands of lost manufacturing jobs, a currency that spent long stretches under real pressure, and entire provinces, especially Ontario, absorbing damage that diversification numbers on a national spreadsheet don't fully capture. On the American side, the tariffs did generate real leverage and did pull some domestic manufacturing investment homeward, but they also fed directly into inflation at exactly the moment households were already stretched thin, squeezed small suppliers like Mike's shop harder than the large automakers they feed into, and left the foundational trade agreement between three deeply intertwined economies in a state of prolonged uncertainty rather than renewed stability. If Canada is ever remembered as the country that came out ahead in this particular clash, it will be a relative kind of victory, measured in resilience and adaptability rather than in any American defeat, and it will sit alongside real and lasting costs that Canadian workers and businesses paid along the way. History, going all the way back to Smoot-Hawley nearly a century earlier, keeps delivering the same underlying message. Trade wars are rarely won in any absolute sense. They are endured, and the economies that come out relatively better off are usually the ones that adapted fastest rather than the ones that pushed hardest. In an economy as globally wired together as this one, where a bracket made in Ontario ends up in a truck assembled in Michigan and sold to a customer in Texas, where Alberta crude increasingly loads onto tankers bound for Seoul instead of Houston, where a tariff announced in Washington on a Monday morning shows up as a price change on an invoice in a small Michigan machine shop by Wednesday, there simply is no version of economic conflict where one side gets to walk away completely unscathed while the other absorbs everything. The deeper and more useful lesson, the one worth remembering long after this particular round of tariffs eventually fades from the headlines, is that modern prosperity was never really built on any single country beating another. It was built on the kind of steady, boring, unglamorous cooperation that people like Mike depended on every single day without ever thinking about it, until the day it wasn't there anymore. There's also a longer-term structural story sitting quietly underneath all of this that neither government particularly wants to advertise, because both sides come out of this period having learned the same uncomfortable lesson about concentration risk. Canada learns it does not want to keep exporting nearly all of its energy and manufactured goods to a single customer, no matter how close or friendly that customer has historically been. And American manufacturers learn that, just in time, supply chains stretched across an undefended, invisible border are far more fragile than decades of smooth trading had led anyone to assume. Companies on both sides start quietly rewriting their sourcing strategies for the next decade, not just around this specific dispute, but around the general possibility that tariffs, once normalized as a political tool, could return again in some future administration, regardless of which party is in charge. And that possibility alone changes long-term investment decisions in ways that are much harder to reverse than the tariffs themselves. Some economists who study global trade point out that this pattern, countries hedging against overdependence after a painful shock, tends to reshape trade relationships permanently, even after the immediate conflict cools down, meaning some of the diversification Canada pursued out of necessity in 2025. In 2026 likely becomes a permanent feature of its economy rather than a temporary workaround, the same way earlier generations of trade disruption pushed countries toward the multilateral trading rules that still govern most of global commerce today. Meanwhile, back in Washington, officials frame the entire episode as evidence that tariffs can be used as effective leverage to correct what they describe as decades of imbalanced trade relationships, pointing to the fact that Canada eventually removed most of its own retaliatory tariffs, opened new discussions on dairy and auto market access, and came back to the negotiating table repeatedly despite public toughness in its rhetoric, while critics on the other side of that argument keep pointing to the inflation data, the job losses concentrated among the smallest and least powerful suppliers, and the prolonged uncertainty hanging over the broader trade agreement as evidence that whatever leverage was gained came at a cost that will take years to fully tally. Both arguments contain real truth, which is exactly why simple headlines declaring a winner and a loser rarely survive contact with the underlying data for very long. What tends to get lost in the noise of tariff percentages and GDP forecasts is the sheer number of ordinary decisions being made by people who never wanted to be part of any of this. A small shop owner deciding whether to keep 2 machinists on payroll through a slow quarter, a family in Ontario deciding whether this is the year they finally take that trip to Florida or spend the money at home instead, A farmer in the American Midwest deciding whether to plant a crop this season based on assumptions about export markets that could shift again before harvest. A shipping company in British Columbia deciding whether to bet on long-term contracts with buyers in Seoul rather than the traditional customers just across the border. Each of those decisions, multiplied across millions of households and tens of thousands of businesses on both sides, is what actually determines how a trade war plays out in the real economy, far more than any single tariff announcement or press conference ever could. And that, ultimately, is the part of this story that rarely makes it into the headline, because a headline needs a winner, and a headline needs a clean, satisfying ending. But the actual lived experience of an economic conflict, this deeply woven into daily life, almost never resolves that neatly. It just gradually fades into a new normal that everyone quietly adjusts to, the way Mike adjusted his quoting process, the way Canadian exporters adjusted their client lists, the way both governments eventually adjusted their rhetoric once the political costs of continued escalation started outweighing whatever leverage they still hoped to gain.